All right, so expense management is another important element of the financial planning process because this is where things really tie together. We get to see where the assets are coming from, how you're funding your goals, in terms of income now and income later for retirement. Um, and we can really kind of see the recommendations get put in place by making those expense management modifications. So aside from setting yourself up, to be self-sufficient in retirement, you've expressed that it's also a priority for you to fund Becky's college. So these objectives were addressed primarily in the investment and retirement education planning section. However, they are important because we will be using cash flow to fund these goals. So we mentioned that we're pulling the savings away from funding your joint account into making Roth IRA contributions and 529 contributions on an annual basis. So we simply recommend that you just reposition these monies that you're already putting towards your taxable account to just go towards your respective retirement and college planning accounts to meet your goals. So we suggest that you keep your 401k contributions the same, and those are kind of the only changes there. So really no additional expense in college and retirement planning. As for your concerns about having adequate insurance coverage, we did mention that we feel you'll need to increase your life insurance policies as well as your umbrella policy. So for the life insurance policy, we recommend that you purchase 20-year term life insurance policies with a $2 million worth of coverage. So with that, this would be on top of your existing policies, and this will raise your premiums an additional $3,156 a year. We also recommend that you increase your umbrella policy coverage to $1 million, just because your net worth is right under $900,000. This expense will be another $75 a year in expenses. So to supplement these additional costs for your additional premiums, we recommend you do three things to reduce your annual expenses. So first, we suggest that you pay off your existing credit card debt of $5,500 using your checking account and a few $1,000s from your savings. Main reason for this is that the interest on these credit cards is astronomical. So just in interest alone, on an annual basis, you're paying $2,400 a year. So we recommend you pay this off, you pay off this debt. This will reduce your cash reserve of all those checking, savings, Mia's art gallery account, all those accounts that we were considering your cash reserve account. That'll reduce it down to $23,000. So before it was $28,500. By paying off the credit card debt, we reduced that by $5,500. So we'll kind of go over your cash reserve need and your goal for that, of having 6 months worth of expenses in a little bit. So our second suggestion is that you terminate your charge card. So without further information on what exactly this card is, we recommend that you just pay it off completely and terminate the card because it is costing you $225 a month just to keep it operating. Without too much more information about this, we do understand that this type of charge card has to be paid off monthly anyway, so we figure you might as well just eliminate it altogether. Lastly, we recommend that you refinance your mortgage. We will factor in the one-time 3% closing costs, at the end of this section, but we do feel that refinancing the mortgage to a 20-year fixed at 6% would put you in a better situation. So you currently have a 30-year fixed mortgage rate of 7.875%, and you're about 10 years into it. So by refinancing to the 20-year fixed rate, you're still going to pay off the house in the same amount of time before retirement. In 20 years, it'll be 62. But not only will you pay off the house in the same amount of time, you'll be reducing the monthly payments. So instead of paying $1,088 a month, you'll be paying $934 a month, which is a savings of just over $1,800 annually. So in total, with all these three things, paying off the credit cards, eliminating the charge card, and refinancing the mortgage, you will have saved $6,948 a year. And this more than covers your increased premiums for additional insurance coverage. That will be an added cost. This also will cover the 3% refinancing costs and estate attorney fees that we'll go over in the estate planning section, which will be a one-time cost as well. So you also mentioned that you'd like to build up your cash reserves to be 6 months worth of all discretionary and dedicated expenses, so not including taxes paid. According to our calculations of your annual expenses with our recommendations, your cash reserve need comes out to be about $48,211. So you currently have $23,000 after paying off the credit cards, and this includes your saving account, which has about $8,000 left. The checking account's been closed out. We use that to pay off the credit cards. It does include your money market account with $10,000, as well as your second checking account that has Mia's Art Gallery savings. We suggest you keep these assets as they are, so keep them, as they are for emergencies, and that you also consider the EE bonds as part of this cash reserve. So if you were to wait 5 years, those bonds would be worth about $25,000, and then in 10 years they'll mature and reach face value at $30,000. So this will bring you to more than enough to meet your cash reserve need. We do feel that if something were to happen, you wouldn't need all $48,000 all at once. So please do keep us tuned, if something does come up, and we can kind of walk you through where to pull the funds as those issues arise. Another thing we wanted to point out was that although you both anticipate that your salaries will increase by 3% every year, we also assume that inflation and the cost of living will adjust by 3%. So we're not factoring in any sort of increase in net discretionary income to add to your savings. We're assuming that everything kind of washes out, aside from the modifications to expense management that we're making. The cost to refinance your mortgage comes out to be $3,790.43. This is a one-time cost, so it's a 3% on the loan amount, and it's been factored into your budget, so there will be enough discretionary income left over to pay those fees. You'll also need to work with an estate attorney to put your estate together, your estate plan. So the details of this will be outlined in the estate planning section, but we did want to mention that we have factored this in. So the cost to hire an estate attorney, should you decide to work with any of the referrals that we provide you with, is $2,000 total, and it's a one-time expense, flat. And we do feel that this will be, more valuable than expensive, even though it's not cheap. In summary, we've made modifications to your overall financial plan to improve your expense management and reposition what you're paying for, or what you're paying into currently. So in terms of insurance, debt, retirement, college savings, we want to make sure that we're able to meet your goals, and that's what drives the modifications that we've made. So all in all, with all the changes that we've recommended, the annual savings left over in discretionary income is $7,764. So this will more than cover the one-time costs that are necessary to put your plan together in terms of refinancing your mortgage and hiring an estate attorney. So for this year, after all those costs are factored in, there will be $1,973 left over that you can add to your cash reserve, and then every year after that, that $7,764 could be added to your cash reserve saving. So on page 24 and 25, we show you your current income and expense statement. And then on pages 26 and 27, we go through our recommended modifications where we highlight the changes in your expenses. So you'll see we highlighted your mortgage loan payments. Those have reduced. And your credit card payments and charge card payments have been eliminated. Your life insurance premiums have increased, and your umbrella insurance premiums have increased as well. And then at the bottom on the next page, you'll see that we added your Roth IRAs and Becky's 529 account. On page 28, we go into your current net worth statement. No changes have been made here. Your total net worth is $886,823. And on the next page, on page 29, your net worth has actually stayed exactly the same. We've just repositioned some of your assets. So we've used on the left-hand side some of your non-qualified assets to pay off your credit card debt. And we've also added, several accounts that haven't, yet been funded, the Roth IRAs and the 529. So that's really the only delta difference there. And now we'll move on to tax planning. So before we jump into your tax situation, we thought it'd be beneficial to give a little bit of background regarding tax rules and implications of your assets. So in reference to the different tax buckets, we put up a chart on page 30 of your plan to kind of make these this simple. So just referencing that graph, most of your assets are either in a qualified plan or taxable accounts. So a qualified plan would be your 401ks, your traditional IRAs, and taxable accounts would be things like your savings accounts, any sort of taxable investment account that you have. So the difference in the way that these are taxed is pretty simple. All of your 401ks and IRAs give you some sort of tax deduction now. So not even talking about the Roth IRAs, that's a little bit different. The traditional IRAs and the 401ks, when you contribute into those accounts, those contributions are tax deductible, meaning you're not taxed on those in the years that you contribute, and those accounts grow tax deferred. So essentially by the time that you're retired, by the time that you withdraw from those accounts, those assets have never been taxed. So once you pull those assets out, they're taxed on the federal and state levels. When you take your RMDs, for instance, your required minimum distributions at age 70 and a half, those distributions will be taxed. Roth IRAs, on the other hand, those contributions are after-tax dollars. So those are non-qualified plans, and they grow completely tax-free. So there's no RMDs required on those. Once you're over the age 59 and a half, you can take funds out of your Roth IRA completely tax-free. For taxable accounts, anytime there's a capital gain or dividends, you will receive a 1099, at the end of the year for those taxable accounts, because any dividends or liquidations result in capital gains taxes or in a taxable event. Let's say, you sell something more than what you paid for it, that'll be a capital gain. If it's something that you held for 10 years, that'll be a long-term capital gain. Or if it's a loss, long-term capital loss. Capital gains rates range from 15 to 23.8%, which includes the Obamacare surcharge tax. So keep in mind that you can also carry losses over from year to year. The maximum losses that you can deduct from your income is actually $3,000. So we already mentioned this in your retirement planning investment section, but we wanted to kind of reiterate the importance of having access to tax-free money and diversifying in a tax way as well. So we definitely encourage you to open the Roth IRAs. It kind of gives you that flexibility at retirement so that not everything that you're taking out of your retirement assets is taxable.